Good evening, traders. It is Wednesday, March 18th after the close, and that must mean that it's time for the weekly swing trading video. It has been a rough month of trading, I'll tell you that. Actually, we've done very well day trading it, but from a swing trading standpoint, I think we had some trades that went off about 3 weeks ago. Those all ended up expiring for us, but apart from that, week in and week out, we've chosen to be in cash. I've produced the videos, but I have recanted the next morning saying, don't do the spreads. It's just not worth the risk. And I think some of those positions would have worked out, but certainly many of them would not have. When you've got a market free fall like this, you just got to step out of the way, let it do what it's doing. Could we have bought some puts somewhere along the lines? Probably yes. And we could have made decent money on it, but the risk was always present that we could have a gigantic snapback rally, and I did not want to be subjected to that, especially since we're swing trading and the communication is very difficult since most of you work during the day. So we don't want to take that kind of risk. We want to have positions that we can place and that kind of take care of themselves. And that really is my objective this week, is to find those types of trades. If they're out there, let's do them. If they're not, let's be patient and wait. I've got some good picks this week. We're going to be trading this week. The odds are so good on these trades. We're going to trade. We're going to do them. So we're going to use a little bit of a different strategy to trade them. And I'll talk a little bit more about that once I've had a chance to look at the market with you. So we've got the 100-day and 200-day moving averages here. The black line is the 100-day, the 200-day. Look at how distant they are. They are just a mile away, up around the $300 level. The market today was up at about 235 at one point, and it broke that support. We do have a little bit of a bullish, it's not a hammer really, it's just the market had big tails above and below and finished right in the middle of the trading range. There's not a whole lot that we can interpret from this. There's still a lot of selling pressure. Even though the government has come out, there's been $1.5 trillion of liquidity added to the system. There's a $700 billion quantitative easing program. Interest rates were cut to 0%. So massive liquidity injection. That's not a problem. We've also got federal stimulus. There are going to be checks going out in April and in May. I'm hearing numbers that it could be $1,000 for each one of them. There will be all sorts of government bailouts and bridge loans needed for industries that have been hit the hardest. All of this comes down to one thing: time. We need time, and we have to see how things are going to play out over the course of the next couple of weeks. This is a critical chart that I posted in the chat room this morning, and the most noticeable thing is the countries that have gone out to the 30-day timeline. So the timeline starts when there have been more than 100 confirmed cases of coronavirus. And you can see that in the case of South Korea, it flattened after 30 days. China, if you can trust their numbers, flattened after 30 days. Japan starting to flatten out, creeping just a little bit higher, but they're not quite out to the 30-day horizon. But you can see other countries. Italy's getting pretty far out there right now time-wise. They are at about the 21-day mark, so they've got about a week left. They have had a very, very steep rise. Now, again, a lot of this has to do with the testing. Before you test everyone, you don't know how widespread coronavirus is. Once you start testing everyone, you get an accurate count and an accurate assessment, and then you can accurately gauge the rate of increase. So we're still at that stage right now in the US where we're trying to figure out how many people currently have it. So that number is going to go up dramatically in the course of the next week or two, and that is going to freak everyone out. When they start seeing that number rise, they're going to assume that it's because the virus is spreading. No, it's because we're just starting to identify how many people actually have it. And only after that 30-day period can we expect to start seeing it flatten out and to start seeing the number of new cases decrease dramatically. So we need to knock it down. We need to practice social distancing. That's what's happening. Schools are closed, businesses are closed, bars, restaurants. The CDC said that we should not have gatherings of 10 people or more. Uh, all sorts of things. You read the news, you see the headlines, you know what's going on with coronavirus. This is the important chart. This cannot last more than about 3 or 4 weeks, this self quarantining, because people are going to eventually start getting out and about. Businesses are going to have to get back on their feet very, very soon. We can have a reprieve, but the helicopter drop from the government, we're not going to see this 2, 3, 4, 5, 6 times. This is pretty much going to be a one and done. They're hitting this with all they've got right now, and they're trying to make sure that we knock this virus down right now. We've got warmer temperatures coming. Hopefully, that will slow the spread of the virus. It has a tendency to do that. So we have to sit tight a little bit, but we have to also expect that over the course of the next week or two, that fear is going to increase, not decrease. And until we start seeing this flattening curve in another 2 or 3 weeks, I think the fear level is going to remain high. Once the number of new cases starts to decrease and we can kind of get our arms around everything, then I think everybody starts to relax a little bit more, and very, very gradually, middle of May, things start to get back to normal. Businesses start reopening, and then we'll probably have at least a 1 year recovery process from an economic standpoint. So there's more pain ahead, but I believe that in the next 2 or 3 weeks, things are going to look better than they do right now. So, how do we trade that? How do we approach that? Well, I've got some stocks that I looked at, and I'm not using any of the searches to do it. Right now, it's really lift up the hood, take a look at the fundamentals, and use that type of approach. I've been through a number of these crashes before, so I know what to do. I've got a routine, and you really have to appeal to your own common sense when you take a look at some of the stocks that I'm going to be showing you tonight. And at what price are you willing to buy that stock? And which companies make the most sense? You're going to see some of the same names that I've had out there because these are the companies that won't be that impacted by the coronavirus. So let me go to the first one on the list. And by the way, I'm not reviewing the trades from the prior week because we didn't do any trades from the prior week. I told everybody, hold off, we're not doing any trades. This week, we are going to do trades, but we're going to do them very, very small, and we're going to be selling naked. Ooh, that sounds scary. Naked out of the money puts. Actually, it's a very conservative strategy. It's equivalent to covered call writing. Okay, except you have to put up less margin because you're not buying the stock and selling a call against it. You're selling it out of the money put. But the risk profile is exactly the same. And on some of these stocks, I'll tell you right now, if we get assigned on any one of these stocks, we're going to take assignment. Period. I want to get assigned on these stocks. We will be buying these stocks at the biggest discount, and I would love to have a chance to buy them there. And if by chance we can't buy them there and we don't get assigned, then we're going to generate some income while we wait. And that's what swing trading should be. It should be a relatively maintenance free position, especially in this kind of market right here. So this is not a time to go gangbuster, but this is a time for us to dip our toe in the water to try and get some really good value. So let's take a look at what we've got. We have Cisco Systems. Cisco, pretty nasty decline right in here. You can see though that it has relative strength. It's actually been bouncing off of the support level around the $33 level. So let me put the SPY overlay and then it'll become more apparent. You can see how the market has been down, 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 but the stock is not making new relative lows. In fact, look, it closed at $37 today. I like Cisco. Do you know that internet traffic is up 40% since the coronavirus? You've got people watching more movies, they're staying at home, they've got their kids are having to do homework assignments online, businesses are communicating over the internet. Well, guess what? Cisco provides network routers that help us communicate over the internet, all the switches. This is a really good business to be in because that traffic is going to require more equipment. So I really like Cisco for that reason. I like the fact that it has found support, so it's strong relative to the market, and I love its balance sheet. So we're going to take a look at the balance sheet real quick. I'm not going to do anything high power, but as you know from my comments every day, I keep writing, cash is king. So we want companies with cash. That means that they're going to be able to withstand whatever happens over the course of the next 2, 3, 4, 5 months, and even longer if they have to. Well, if you look at Cisco's cash, they've got $6.38 per share cash. If they wanted to, they could use their cash and pay off all their debt and still have $2.38 left over. Beautiful. I love it. That's the kind of company I'm looking for. Look at this forward PE, 11. Very cheap already. But it gets even better because we're not going to sell an at the money option. We're going to go out of the money. And we want to go way below this $33 price level. We want to see if we can buy this stock even cheaper. Mind you, the stock closed at $37. So when you see these option premiums, you're going to go, whoa, that looks like a pretty good deal. And we're going to go out to April 17th, regular expiration. Why? Well, first of all, we're going to have better liquidity on April 17th because it's a normal expiration cycle. And I think that by that time, we're going to start to see some light at the end of the tunnel, and everybody will start to relax a little bit more, and I think the market will find its footing. So in the meantime, though, we have to expect that, yes, the market is going to sell off and stocks are going to sell off. So we want to go as far out of the money as we can on these. And so I've already got this queued up in the staged panel here. So when you click staged, you'll be able to see all these orders. And if you look at Cisco, I'm looking at that April 30 put, and I'd like to get $1 for it. And we're only going to sell, well, you can sell as many as you want, but I've got one queued up here. So let's take a look at that April 30 put. You can see it's 75 cents bid, offered at $1.54. Your bid side at $1, we can get filled on this. We should be able to get filled on this right away, even based on where the stock closed today and where the market closed today. I think if you saw a market sell off overnight, it would be prudent to wait and see if maybe you can get $1.25 for it. Maybe you can get a little bit more than that for it, but I wouldn't wait too long because I think this is a compelling value. So the stock can stay flat. The stock can rally. The stock can go down 20%. And we're still out of the money. It can actually go down almost 30%, and we're still out of the money. Look, the stock closed at $37 today. This is 33 right here. This isn't even a $30 strike price. All the way down to $30. So if you like that PE of 11 and you thought that was attractive, well, you can shave another 30% off, and you can see that you'd probably be getting this stock at somewhere in the neighborhood of a 7.5 PE. Wow. Okay. Yeah, I'll buy Cisco at $30. And you're actually not buying it at $30 because you got $1 for that put that you sold naked. So you'd actually be buying the stock at $29. And I'll tell you, if we do get assigned at $29, I would prefer to hold the stock for a while because I think that would be buying it at a very, very good level. But if the stock rallies a little bit, we're going to sell an at the money call, and we're going to bring in all that premium. Maybe we have a month or two left till expiration, and we hope that the stock gets called away from us. And if it does, we'll net be up by the put premium we collected and the call premium. It will generate a really nice rate of return. So in order for me to do this trade, Pete, how much money do I have to put up for a naked put like that? Well, you do get relief for out of the money. So I'm going to keep the calculation very, very easy. Basically, if you take 20% of the strike price, you're going to be just fine. So in this case, if you've got a $30 stock, you're going to have to put up somewhere in the neighborhood of $6 per contract to do this trade. So 20% of that 30. So I've got to put up about $6 per contract. I'm going to be bringing in $1. This trade's going to be lasting a month. So 1 divided by 6, that's going to be somewhere in the neighborhood of a 16% return in a month. Not bad. And look at the probability of success on this trade. Cisco can go down. Hey, if the market falls apart, that's fine. Is the market going to fall apart another 30% from here? It could. I think the big hit has already taken place on Cisco, but let's say the market falls another 10%. How much is the stock going to lose? I don't know. Could it lose 10%, 15%? Yeah. 30%? Not very likely. I don't think so, especially given the support here and especially given the backdrop with everybody needing to use the internet more. I think Cisco is in a great place right now. And again, we're talking about the course of a month. We've got to get through the next month. I really like this trade. So let's move on to the second one. And why am I selling naked puts again? Why are we doing this naked? Why aren't we creating spreads here, for crying out loud? Because I don't want to buy any expensive out of the money premium. All the premiums on options are super inflated. And yes, could I try and go in here and do a different spread on this? I could. Then I'm going to be leveraging myself up. And if the stock pulls back, then I'm really in trouble. You know, if you do these as an investment, and if you have gotten to cash, which I hope that most of you have, you've got cash sitting on the sidelines right now. So use an investment type approach. And if you've got to sell a $30 put, if you have $15 in cash sitting on the sidelines, you'll always be able to buy this stock on Reg T margin. So you can do that if it makes you feel more comfortable. But I like the return on this trade. 16% in a month. That's a really nice return. Plus, we've got probability working in our favor. So I'm not going to sell this one and buy a goofy, way out of the money option. And look at the bid-ask spreads on these things. 20 cents bid offered at 75 cents. So now I've got to navigate another option in here and try and work something in the middle. I don't want to deal with that. Just sell the dang put naked and let's hope that we get assigned on the stock. And that's another reason that you want to do this, is because all the option prices are so whacked out. Just sell the put. It's one leg. Not a big problem to buy that back in if you have to. So in terms of a stop on that, I don't have a stop on it. I want to buy the stock at $30, net $29. No stop. Okay? This is more of an investment approach, and I want to do the trade, and I want to do it tomorrow. So let's take a look at the next one, Facebook. You've been hearing about Facebook for a while. People are not going to be using social media less. They're going to be using social media more. They can't do face-to-face meetings with each other. They want to keep apprised of what's going on. They'll feel cut off from the world because there's nothing going on in their house while they're using social distancing. Plus, you've got Facebook's revenues have been up incredibly recently. And if we take a look at the valuation of Facebook, we'll go into stock ER. And here you can see we've got another situation. Cash per share, $19 in cash. Debt, tiny, $4.60 in debt. So they could pay off that debt, no problem. They got plenty of cash to weather this storm. Let's say that this lasts 2 or 3 or 5 months. Facebook's got plenty of cash. Their employees can work remotely. They don't have supply issues. Supply is coming in from China, so there's no chance of a supply disruption. This is a really great play. Look at the forward PE of 15 at this current level. Cheap, cheap stock. So again, we're going to use probability and we're going to go way out of the money and let's see what we can get. We've got option implied volatilities screaming higher. Look at the VXX. Look at that thing. It got up to 76 today, down from about $10. This tells you how expensive options are. We are being rewarded for taking risk right now. So let's take some risk. Let's put our toe in the water. We're not going to go gangbuster. These are great trades though. So let's take a look at the staged orders, and you can see that I've already got Facebook loaded up. We're going to sell one Facebook, April 17, $100 put, and we're going to try and get $2 for it. So let's take a look at that. Put in Facebook. And we'll go to the April 17th expiration. We're going to go to the $100 put. We're going to try and get $2 for that. It is $1.80 bid, offered at $2.21. I think we're going to get filled at $2. We might even get filled at $2.50 or $3 if we wait and we have a market pullback tomorrow, which there's going to be pullbacks between now and the expiration date for sure. But with every passing day, these options will get cheaper. And if there happens to be a big market pop or a big market jump, anywhere in between there, you'll see these premiums come out instantly. So I wouldn't hold off on this. So at $100, let's take a look at the stock, and we'll put up Facebook. You should already know that if we've got a $100 stock and we have to put up 20% of the strike price, we've got to put up $20 for this, okay? We've got to put up $20 in margin, and we've got Facebook currently sitting at $146. Folks, this stock can lose a third of its value, down to $100. Take a third of the value and you start looking at this stock ER, it'll be trading at a forward PE of 10. Facebook will be trading at a forward PE of 10 at that level. You'll have $20 in cash. That's almost a fifth of the price of the stock in cash. I'll do this as often as I can. This is a really, really good deal. You don't get these types of deals very often. So we are going to be rewarded for taking some risk. So if I get $2 for that trade and I have to put up 20 in margin for that short put position, that is a 10% return in a month. Zero interest rate policy. It's a good way to put your cash to use. Very, very high probability trade. Would you want to own Facebook at $100? Actually at 98 because we're collecting $2 in premium. This is a good swing trade. I like it. I hope you like it. So we're going to try and take advantage of what we've seen happen here. We're going to generate some income. It's time. This is a more expensive play, and this is going to require a considerable amount of money because Google, gosh, I wish they would split this stock, but Google's currently trading around $1,100. I love Google. Social media, no supply issues from China, workers that can work remotely from home, search engine use going to go up during the coronavirus when people are sitting home. YouTube video viewing is going to continue to increase with or without coronavirus, actually. I watch a ton of YouTube. So I think YouTube is going to continue to grow. I love it. So let's take a look at where we would want to buy Google. And I'm going to put up a monthly chart. I'm going to put up a monthly chart of Google. Right here you can see the 100-month moving average for Google. And it comes in right here around the $840 level. And I'm going to put up, have the 200 up. We're going to go as far out of the money as we possibly can on Google, just because we can. And we're going to continue to try and give ourselves the highest probability of success. So we're going to go all the way down to the $650 strike price. So this stock can lose more than a third of its value. and would still be okay. We'll go into that stock ER. Look at the cash per share. $174 in cash per share. They've got debt of $46. They could easily pay that debt off and still have $130 in cash per share. Forward PE 19 and a half, very reasonable. If you take a third of that off, figuring that the stock can lose a third of its value, actually closer to almost half of its value, you're looking at a forward PE in the neighborhood of 12. Is Google going to do less business because of coronavirus? No. I think they're going to do more business because of coronavirus. So let's take a look at the options on this one. And we're going to go into the chain here and we'll put in Google. First, I'll show you the staged order. And we've got that set to go. So by the way, you click trade. And instead of clicking trade for the option chains, you can see orders, portfolio, everything here. You'll go to staged. And if you want to submit this order, it'll be submitted as is on a good till cancel basis to your broker right away. So I would suggest maybe entering these trades yourself. You could put them in automatically. I haven't adjusted them for higher prices. With the market opening dramatically lower every day, I would almost say handhold these, enter them. Don't feel like I got to do these tomorrow morning or else. No, these aren't spreads that expire in a week or a week and a couple days like we've been doing. These expire April 17th. So there is some time, but I would not wait probably more than a day or two because I don't know what the market's going to do. I think there's going to be more fear, not less, over the course of the next couple of weeks. So I think that we're still going to see some selling pressure, but you never know what could turn that sentiment around. So we don't want to miss this opportunity because we're seeing really, really good value here. So again, let's go in and take a look at that Google, the 650 put. We're going to try and sell that for $6. Well, at $650 for the strike price, whoops, I meant to put up that option chain. For a $650 strike price, which is right there at the bottom, you can see those options are bid 450, offered at 750. Could we get $6? Yeah, I think $6 very doable right here and right now. Well, we would have to put up $1,300, which is actually $13,000 per contract. So very, very expensive trade. You're going to bring in about $600 on it, and you might go, whoa, 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 wait a minute. I got to put up 13 grand for this trade, and I'm bringing in a measly little $600. What kind of stupid trade is that? Well, that is actually a 5% return on investment in a month. That's not a bad return on investment in a month. That's 60% a year. If you annualize it, given that interest rates are currently at zero, given that the market is falling apart, given that Google at $650 can lose almost 50% of its value from here. That's a good trade. That's a good way to make 5%. I think that is money in the bank. Could Google fall down to $1,000? Could it fall to $800? Yeah. 700? I don't know. I'm starting to doubt that it would fall that far, but I guess anything's possible. I seriously, seriously doubt it. Think of the other companies and where they would be, not even Google, because Google, I think, will hold up relatively well given its balance sheet and given that forward PE. But you would be buying that stock somewhere at a forward PE of 10. Even if everything falls apart, I think Google, being the #1 search engine in the world, is always going to find a way to make money. YouTube just keeps growing and growing in popularity. If I had to own a stock, this would be one of the ones that I would really want to own. And this is a chance for you to say, I don't think Google's going to fall by 50% in the course of the next month. And because I feel that way, I'm going to make a 5% return on the money that I put up. That's how I would look at that particular trade. I really like it. I think this is a really good conservative way to make 5% in the course of the next month while we wait. This is a waiting game. We have to wait for signs of support. We got to wait for the coronavirus to run its course. We need to see the number of new cases start decreasing, and then everything can start to fall into place economically. Twitter, this is a great way for people to communicate. And if you take a look at what's going to happen throughout the course of the year, you've got Donald Trump tweeting, you've got all sorts of political news out there. People are going to be trapped in their house, they're bored. They're going to be trying to find ways to get information, and Twitter is one of the ways that they can do that. And you know I like this stock, and it's same type of play here. Lots of cash. Lots of cash on the balance sheet. So here you can go down to the cash section here, and you can see they've got $8.50 in cash. They got about $4 in debt, so they could pay off that debt and still have $4 in cash. If you take a look at the forward PE of 28, okay, yeah, that's a little bit lofty. But, I took a look at their earnings report, and last year they made $1.87. So will they make $1.87 this year? Is coronavirus going to hurt them? I think they probably will be on track to do something similar this year. I don't see their usage going down because of coronavirus. I see their usage going up because of it. They've got employees who can work at home. They don't have any supply disruptions coming out of China. These are really, really solid plays, in my opinion. So let's take a look at that staged order screen right now. Let me bring that up. And all right, so here we're going to go into the staged orders. And on Twitter, again, we want to go as far out as we possibly can. We're going to be trying to sell the April 17 15 puts. $15 puts. The stock's at $22. So this stock can lose $7 before it gets to the money. So it can lose a third of its value. And we're trying to sell those $15 puts in April, and we're going to try and get 75 cents for them. So let's take a look at that trade. And we're going out into April 17th. We're going down to the $15 puts. Yes, that would be splitting the bid-ask spread right now is 75 cents. So actually we would own the stock at 14.25 because we got the 75-cent credit in. So if we lap a third off of its PE ratio, we start to take a look at Twitter, it looks much more attractive at that level. So the forward PE was a little bit inflated on the stock, but not bad. And there you can see the forward PE is 28. So if you take a third off of that, you're probably in high teens for a forward PE at $14, $14.75. But at that level, you've got $8.50 in cash. These guys are going to be able to weather the storm also. They've got a very, very strong balance sheet. And again, social media, people communicating, no supply disruptions. I think these stocks are a slam dunk. I think all of these plays are going to pan out for us. And so on a stock like Twitter, we have to put up about $300, but we get to bring in $75 in premium. So there we've got a return of somewhere around probably, well, I'm going to have to get the calculator out for this one. So we're bringing in $75 and we got to put up $300. That's going to be a 25% return. So we're taking a little bit more risk with Twitter. It's got a higher PE, tends to move a little bit more. You can see it's been falling, but we're going to be rewarded better on that one as well. And I would go farther out of the money if I could, but I can't on this one because it doesn't have any options that are further out of the money than that. You can see the $15 strike is it. But I like it. I cannot imagine these stocks getting down to the price level that I've just mentioned in the course of the next month. That's an important statement to make. If the market falls apart, let's say this summer, and oh my gosh, coronavirus is continuing to spread and businesses now are having to remain closed for 2 or 3 months. The government's done their helicopter drop. The money's starting to run out. the financial system's getting all stressed, yeah, anything can happen then. We're not going to be around for that. These trades are going to expire in April, and then we'll take another look at the market. We'll see what's happening, and we'll be able to reset. If by chance we do get assigned on these stocks, we want to be assigned. I'm not using a stop on these. We're going to turn right around and we'll sell some really expensive call premium because premiums will go sky high. If we get assigned on these stocks, option implied volatilities will not go down, they will go up. And we are going to sell some really expensive calls against the stock, and eventually we'll be assigned on the stock and we'll have collected premium on both sides. That will be our gain. That's how we're going to play it. Gosh, these are such high probability trades. Don't do large size. So if you do the Google trade, you can kind of figure out what you'd have to allocate to the others. But the Google trade, I would just be a little bit separate on that one and say, okay, I'll do one contract on that one. I know I'll do more on the others, but I don't have to use the same dollar allocation. Google, we're only going to make a 5% return on, but we're going to be so dang far out of the money. We're just looking to make 5% on that trade. On all these others, I would go a little bit lighter. I would probably go the lightest on Twitter, and I really like the Cisco play. I would probably do a little bit more on that one as well, and Facebook. So that's how we're going to play it right now. We're going to do these trades, and this is a longer term position. We don't often do positions that span 4 weeks, but we've got an opportunity right now to take advantage of some inflated premiums, and we've got a market that has been selling off like mad, and we can expect that to continue. How far could the market go down? Where is that bottom? I don't know. I'm going to try and show you a couple of support levels. If we go on to the monthly chart, you can see that the 100-month moving average is somewhere around that 216 level. We've also got support here, horizontal support right in there, and that's about the 210 level. That is, I cannot imagine us getting much below that level. That would be a 33% correction in the market. So I think that coronavirus is going to run its course. Everything's going to play out. We had this really, really steep rally. I knew we were in trouble. I started showing you these parabolic wedges that were forming on a monthly basis, on a weekly basis, on a daily basis. I knew we were headed for trouble. Even if it weren't for the coronavirus, the market was super overextended because you had all of these upward sloping wedge formations in here that were signaling everything super hot, way overextended, and that was part of the problem with all of this was there were too many bullish speculators. They got flushed out. Asset managers had very little protection. We know that because option implied volatilities were at historic lows. The VXX right there, you can see this is a weekly chart. Historic lows on VXX. So they weren't buying any put protection. They had no protection on. Once the market started to crack, the asset managers started selling futures, they started buying puts, they started selling stock, adjusting risk, and then you get this type of move out of the VIX up to 76. We want to capitalize on this spike. We want to buy these four stocks at a 33% discount from their current price all the way down to a 50% discount in the course of the next month. Would you buy Google at $650? I wouldn't even think twice about it. I hope I get assigned on that trade. So that's what I've got for you this week. Everyone, take a deep breath, relax. It's going to get worse before it gets better. On a swing trading basis, these are going to be really nice income generators for us. We're going to take advantage of this opportunity. Finally, things have gotten to the point to where they're too compelling for us to pass on it. We've got some good trades set up, but I think that it's going to take quite a while for the dust to settle. Even when the coronavirus starts to settle down and die off, I still think that the economic ramifications are going to take quite a while to resolve, and it could be early fall before we start actually getting back on our feet and then kind of clicking into year end. And it would be really great if we had a vaccine somewhere along the lines, or at least some type of treatment protocol that could help the situation. So I hope you and your families are safe and healthy. We'll see you tomorrow. Thank you.
Thank you for watching this YouTube video. I'm Pete Stolzers, and I'm going to keep the trade ideas coming along with lots of education. So make sure to subscribe to the channel and please turn on your notifications so that you never miss another trade. If you like the content, please give it a thumbs up. I've loaded 2 other videos that I think you're really going to enjoy. Stay tuned. We'll see you soon.